The greatest mistake you can make is believing that external factors are the reason for your losses. The primary foe in this business is always the man in the mirror. He is guided not by cold calculation, but by the deceitful whispers of hope and the paralyzing shouts of fear. This internal conflict between logic and emotion is the real cost of entry into the speculative arena. And until you win this battle, you will never see sustained profit. The market does not care for your intentions, only for your actions, and your actions are the direct output of your emotional state. Hope is, without question, the most costly emotion you can bring to the trading floor. It is hope that convinces you to hold a losing position, clinging to the false belief that a rebound is inevitable logic and the market signal a clear exit, yet hope holds the bag, transforming a manageable loss into a catastrophic erosion of capital. I have seen more accounts destroyed by hope than by any sudden, violent move in the price action. You must understand that hope is a luxury you cannot afford in speculation. It is the enemy of discipline and the primary cause of financial ruin. Never mistake calculated speculative trading for the reckless abandon of gambling. The gambler is playing against known, fixed odds, relying purely on chance and blind luck to carry him through. The successful speculator, however, is dealing with probabilities based on observable facts, price action, and volume analysis. One is an exercise in futility, while the other is a rigorous, calculated assessment of risk and opportunity. My business is speculation, which is the relentless pursuit of facts and their logical consequences, not the baseless thrill of taking unnecessary chances. The market owes you nothing, and it will give you nothing for free. You must earn every single dollar you take out of this vast engine, and that earning comes only from your strict adherence to mechanical, non-emotional rules. If you approach the market with an entitlement mindset, you are already defeated before you place the first order. The successful speculator recognizes that the market is a permanent, impartial entity that tests one's character and discipline every single hour of every trading day. Therefore, you must recognize the harsh reality. Your only advantage lies in superior self-control and unwavering focus on the validated trend. All great price movements, the kind that build significant speculative wealth, begin at a clear, identifiable, pivotal point. This pivot is the moment the market shifts from consolidation or reversal into a powerful new direction. Your entire method must be built around waiting patiently for this point to be confirmed, rather than attempting to guess its arrival. Acting prematurely on a hunch or an unverified feeling is a form of expensive impatience that the market will punish without fail. Wait for the market to do the work, then, and only then, after the confirmation, you must act decisively and without delay. Your singular focus must be to confirm the established trend. You must never try to anticipate a reversal before the market proves it is truly underway. Anticipating a reversal is the amateur's game, a cheap thrill for the ego that always results in severe capital depletion. The professional simply follows the price action, acknowledging that the path of least resistance is the only path worth traveling. The trend is your friend, until the market emphatically tells you otherwise. And you must never preempt the market's own signal with your personal opinion. Attempting to call tops or bottoms means you are fighting the dominant force, a battle you will lose every time. I look for the strength and I ride the strength. I seek out the weakness and I short the weakness. Never let personal sentiment or a fixed expectation cloud the verifiable reality of the price and volume data. The most money is made simply by identifying the momentum and having the patience to ride the full extent of the move. You must cut your loss short, and you must cut it while it still feels reasonable, not after it has spiraled into a financial catastrophe. The true professional sets a clear line in the sand, a stop-loss, before the position is even entered, defining the maximum risk he is willing to accept. When the price violates that line, the decision is already made and must be executed instantly and without any emotional deliberation. Hesitation at the stop-loss is the single greatest cause of large destructive losses in the speculative business. Never fall into the deadly trap of arguing with the market. The price is never wrong, only your analysis is. I learned long ago that the fastest and cleanest way to cleanse my mind is to liquidate the error immediately. Do not wait for a small rally or a temporary bounce to save your ego and reduce the pain. That small initial pain is the cheapest educational fee you will ever pay in your entire career. The first loss is always the cheapest loss you will ever encounter, and it is the only one you can truly control. This is a critical lesson that separates the amateurs from the masters of this craft. If a trade moves against you by the agreed-upon amount, you have simply made an error in timing, and the cost of this timing error is your predefined small loss. Accept this loss immediately. It is nothing more than a signal that your initial assessment of the current condition was incorrect. A small loss keeps your mind clear, your capital intact, and your emotional stability high, allowing you to instantly move to the next viable opportunity. Conversely, allowing a small loss to metastasize into a large one cripples your capital, distorts your judgment, and fosters a desperate, retaliatory mentality. You must treat your capital like a soldier. Never expose more than a small, calculated part to any single skirmish. You must never, under any circumstances, average a losing position, because averaging down is the direct highway to financial ruin. When you purchase a security at one price and it falls, and then you purchase more at a lower price, you are engaged in an act of desperation, not speculation. You are essentially doubling down on a proven mistake, hoping that two wrongs will somehow make your account right. This action is pure hope, dressed up as an investment strategy. The price has fallen because your original premise was incorrect or at least premature, and the market is telling you loudly that you are on the wrong side. Adding to the position only increases your exposure to the wrong side and ensures a massive, account-breaking drawdown when the market inevitably continues its validated trend. A speculator cuts his losses. He never attempts to feed a losing trade with fresh capital. Your method must be to add only to winning positions, never to those that are actively draining your strength. Price is the ultimate, undeniable source of truth, and you must ruthlessly ignore all external news, all noise, and all conflicting narratives. The price action on the chart already incorporates all the news, all the opinions, and all the hopes and fears of every participant. Therefore, listening to the commentators, reading the economic forecasts, or following the crowd is simply a distraction from the only thing that truly matters. The market does not care what you think it should do. It only cares what it is doing. Focusing on external noise instead of the chart is how speculators lose their discipline and their capital. Your job is not to understand why the price is moving. Your job is simply to recognize the movement, confirm its validity, and act accordingly. The truth is expressed in the closing print and the associated volume, and nowhere else. Cultivate a deaf ear for the gossip, and a sharp eye for the undeniable language of the chart. Volume must always confirm the conviction and sincerity of the price movement. Action without corresponding volume is always suspicious and usually fleeting. When a price attempts to break a major pivotal point on low volume, I view it with extreme skepticism, knowing it is often a false signal or a temporary manipulation. The true, powerful move that will carry significant distance is always accompanied by a clear surge in participation. A strong breakout or a definitive reversal must have the weight of capital behind it, and that weight is expressed in the volume of transactions. If the price moves sharply but the crowd is not fully committed, the move is fragile and likely to fail. I require the volume to validate the price action, ensuring that I am putting my capital to work only in movements that have broad-based, established conviction. Never trust a price move that looks lonely on the chart. Your fundamental duty is the absolute preservation of your speculative capital. This must fundamentally precede every single goal of profit-seeking. Think of your capital as your army. You cannot fight the next battle if you have lost your entire force in the skirmish just past. If you focus first on protecting your downside, the upside will, eventually, take care of itself. Profit is a byproduct of sound, disciplined capital management, never the primary driver. The moment you start chasing profit, you will inevitably compromise your rules, increase your risk exposure, and suffer severe losses. I am only interested in being in the position to strike when the odds are overwhelmingly in my favor, and that requires preserved capital. Treat your reserves as sacred, a fortress that cannot be breached by the temptation of quick, easy money. True position sizing, the cold, hard math that keeps you alive, begins with defining the maximum acceptable risk per trade in absolute dollar terms. This is the first and most crucial calculation, and it has nothing to do with your account size or your current level of enthusiasm. You must decide, based on your total capital and your financial stability, the precise dollar amount you are willing to lose before you ever click the trade button. This dollar amount is sacred. Once that risk is defined, it is a hard, impenetrable barrier that cannot be crossed, regardless of how promising the position looks. This approach immediately removes the emotion from the loss scenario, because the outcome has already been quantified and financially accepted. I do not think in percentages. I think in dollars I am willing to spend to test a thesis. The moment you define this limit, you gain absolute control over the market's worst potential outcome. You must size the position based mathematically on the distance from your entry to your predetermined stop loss, not arbitrarily based on your account equity. This is the simple mechanical truth of effective capital control. If the maximum dollar risk you defined is, for example, $2,000, and the distance to your stop loss is $2 per share, then you can only afford to purchase exactly 1,000 shares. That is the mathematics of survival. If the distance to the logical stop loss is too wide, making the position size too small to be worth the effort, then the trade must be abandoned entirely. You do not move the stop loss closer to accommodate a larger position size. You move the trade to the trash. The market dictates the stop loss location, and your capital dictates the position size. If the market movement decisively and emphatically violates your predetermined stop, your entire initial speculative thesis is invalidated. There is no middle ground, and there is no hope for recovery. The tape has spoken, and it has contradicted your idea. When the price action invalidates your premise, you are wrong, and you must exit the market with the predetermined small loss. To stay in the trade is an act of intellectual dishonesty, a refusal to accept the reality that you misjudge the current market dynamics. A violation of the stop is not a temporary setback. It is a clear technical signal that the line of least resistance is running against you. You must accept that your analysis, however meticulous, was flawed in its timing or its underlying logic. The speculator's job is not to be right all the time, but to lose the smallest possible amount when he is wrong. Always trade in segments. Test the water with a small lot before you commit fully to the entire desired position size. This methodical approach is the hallmark of the professional and the antithesis of the reckless, all-in approach of the amateur. My initial purchase is merely a test, a probing action to verify that my analysis of the pivotal point and the trend is truly accurate. If that initial pilot position immediately confirms the move, only then do I commit the remaining larger segment of capital. If the initial purchase shows me immediately that the movement is premature or that my timing is slightly off, I exit that small test position with a tiny acceptable loss. This systematic segmentation protects the majority of my capital from premature engagement. I never commit my full force until the market itself gives me the verified and undeniable signal of movement. Pyramiding, the act of adding to a position, must only ever occur when you are trading with an existing locked-in profit cushion. You should only ever increase the size of a position in the direction of the trend, and only after the original purchase is already showing a substantial realized profit. The market must be doing the work and confirming your every step before you commit additional capital. Never use new capital to add to an open position. Use the market's money. The profits you have secured act as a natural cushion against any sudden reversal or shakeout in the trend. This method ensures that if the market turns against your enlarged position, the worst-case scenario is simply the surrender of paper profit, not an incursion into your core speculative capital. Pyramiding is not about aggression. It is about controlled, conservative compounding. built entirely on the market's generosity. Patience is the quiet force that makes more true market millionaires than aggressive, premature execution will ever produce. The ability to wait, to sit on your hands and watch the market, is often the hardest and yet the most profitable action you can take. Every day, the market presents dozens of poor opportunities and only a handful of truly undeniable ones. The impatient trader must participate in all of them, thereby bleeding out his capital on friction and false starts. The master only participates in the most obvious and verified movements, waiting patiently for the pivotal point to appear with maximum clarity and confirmation. Your job is not to trade every day. Your job is to trade correctly when the conditions are perfect. The largest fortunes are built not by constant trading, but by sitting with the correct position during a massive, sustained move. You must never, under any circumstances, put all your speculative capital into play at the same time. The maintenance of significant, readily available cash reserves is itself a powerful, indispensable market position. This reserved capital gives you two immense, non-negotiable advantages: emotional stability and operational flexibility. When you have reserves, you are immune to the emotional pull of desperation, because you know you can afford to be wrong on the current position. Moreover, cash reserves ensure you possess the financial power to strike decisively when the ultimate, undeniable opportunity appears. The greatest movements only happen a few times per decade, and if your capital is tied up in a dozen mediocre positions, you will miss the one chance that changes your life. Always keep a powerful dry powder ready to be deployed. You must let your profits run until the market itself, through undeniable price action and volume analysis, signals a clear deviation from the trend. The novice is always in a hurry to secure a small profit, thereby cutting short the only thing that can truly compound a fortune. I have made my money not on my initial idea, but on my ability to sit still and let the great moves play out to their conclusion. Your exit signal must come from the market, never from your own nervousness or satisfaction. If the trend is intact, the position is correct, and the movement is steady, your job is simply to hold. The market will provide the exit signal when the momentum breaks, or the price fails to confirm new highs with sufficient volume. Until that signal appears, the potential profit belongs to you, and to cash it in early is an act of foolish, short-sighted greed. Trading success is primarily about unflinching mechanical discipline, not superior intelligence or a mystical sense of market instinct. You do not need to be the smartest person in the room. You only need to be the most disciplined. Discipline means adhering to the rules even when they are inconvenient and uncomfortable. The biggest winning positions you will ever hold will always require the greatest amount of psychological patience and the largest capacity to endure volatile paper profits. A major trend move is never a straight line. It requires you to tolerate shakeouts, corrections, and minor reversals. You must sit through the noise, holding the position, if you want to capture the full measure of the major move. You must keep a comprehensive, detailed ledger of every single failure to precisely isolate and eliminate your own repeatable, costly errors. I spend as much time analyzing my losses as I do studying my largest wins, because the losses are where the lessons live. If you do not record the trade, the reason for entry, and the reason for the exit, you are doomed to repeat the exact same emotional mistakes. Always reserve your financial power, your dry powder, to strike decisively and with full conviction when the opportunity is undeniable and completely verified. The waiting is the work. The execution is merely the consequence of that patient, disciplined waiting. The great opportunities require a massive commitment, and you must have the resources ready when the time comes. You must always follow the line of least resistance because it is the path of least conflict and the greatest potential for wealth accumulation. The line of least resistance is nothing more than the direction in which the price is moving with the most energy and the least opposition. Your speculation must always be in harmony with this natural flow, never fighting against it. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content. And it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game I am talking about, Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.